What?
Tim Quast, he's the founder, CEO of Market Structure Edge, joining us here. Tim, how you doing?
I'm well, Joel. It's good to see you. Thank you. Good to see all of you.
Tim, I want to
That was
start.
a pretty good segment, I have to say. Dennis,
the
you
Apple.
could sell T-shirts that say, "Why is Warren Buffett hoarding cash?"
Yeah, well, that's
that'd
it.
be a good T-shirt.
Why? I'm hoarding cash too. One, because it's
Yeah.
paying me a lot of money right now, but two is
Right.
because the market risk here is high on a long-term basis. Like, I mean, I'm not looking out a week or two here. Maybe it's high for the next week, but we're traders and we're going to get into, we'll get into the market structure edge and look at that in a second. But before we get into any of that, we had a conversation about 20 minutes ago. So South Korea is banning short selling for the next 3 months or whatever, or 6 months until June because retail protests. So retail says, we hate short sellers, and South Korea government listening, banning short selling. I want to know Tim Quast's opinion because Twitter went crazy on the weekend and saying, why do we allow short selling in North America? Why should we have short selling? Short selling is evil. It's the whole reason why stocks go down. It's the only reason why stocks go bankrupt is because of short selling, Tim. Can you tell me first your thoughts on banning short selling?
Well, I'm opposed to it. It's a natural part of a well-functioning market. There is fear and greed at work all the time in anything that is animated by human nature, and so long as the rules are clear, then I'm all for it. There has to be a clear structure so that it's a level playing field. And my view on the massive presence of market maker exemptions to the short locate rules here in these markets. And we could have a long discussion about whether that promotes a healthy market or not, but it's the reason we can all trade. That is the truth of the matter. So whether we like it or not, without that, you couldn't get in and out of anything with any ease. So if you like to trade, then you better support shorting. It's just a part of the puzzle.
100%. It's exactly what I said 20 minutes ago. I was like, this allows us, it's short sellers that allow us to get in and out of stocks. It's that liquidity that they provide, allowing us to get in and out. So, otherwise your spreads are going to go from here to here. So, I mean, it's a simple, game. Like people think, oh, short selling is just a small portion of the market, but you bring up these stats all the time.
Yep.
It's an enormous part of the order flow that's on the book. How much of that is short sell related? I mean, you've got not only on the short sell itself, people think it's just this side, but on the buy side, it's all covering orders on the buy side related to those short sells. I mean, that market liquidity is all because of short selling.
Absolutely. I had a panel discussion. This was probably a year and a half ago now. And an institutional trader was on that panel, and he said, effectively, 100% of the large orders that large institutional orders require short volume because you couldn't fill them otherwise. And of course, this then for everybody to understand this, we'd have to have a discussion about the history of the markets. Back to the upstairs desk, the wholesale broker dealers. They don't exist anymore because we have a market that depends on high frequency traders like Citadel and Virtu and Hudson River Trading and Jane Street and Infinium and GTS and so on. And they have market maker exemptions, but they are the reason why that you can buy. I mean, go look at some of these, leveraged derivatives, which I trade too. You have to understand what you're trading. You should know what you own. Yes. But you could go, buy SPXL or SPXU. These instruments routinely have hundreds of thousands of shares at the bid and the offer. Well, how's that possible? Well, it's because of the long short provisions in the market.
Tim, one of my buddies asked me, what does the stock market have to do with quantum mechanics?
Oh, here it comes.
And I really didn't have an answer. Do you have an answer for us?
Holy, we're getting physics.
Yeah,
we're getting into physics conversation here at 8:30 in the morning.
What the stock market and quantum mechanics have in common is the uncertainty principle. That is, and so I love math. Quantum mechanics is, just oversimplifying. It's the way everything works. It is the theory of how molecules move in our physical environment. And there is an uncertainty principle. In fact, I talk about this with the edge mob, that you have to realize you can't know exactly what's going to happen. And it's, it's great. You look at the data last week, and the data were better than human nature. The data were better at saying, oh, the market's going to turn than human nature would be. But here's the way to think about this. If there's a ripple on the surface of a pond, you can mathematically determine where the ripple is and its speed, but not both simultaneously. That's the uncertainty principle. And you have to think about that as a trader. You don't know. If we all knew precisely where the bottom or the top was going to be, well, we'd all be rich. And everybody would beat the market. It's very, very difficult to beat the market. And it's important to understand that. It requires understanding the mechanics of the stock market, being very disciplined about what you do. Dennis, I thought what you said about trading it was absolutely right. It's, you make your living being long short. That if you're going to trade, that's what you have to do. You have to be nimble. Don't get distracted. Don't say like, oh, I'm going to off after the shiny thing. Just stick with your discipline and understand that there is an uncertainty principle. We're not going to get it right all the time. I was out celebrating my birthday when the market went up 500 points. So, well, and I don't trade if I'm not paying attention, because that's how you make mistakes. And you say, 100%. Oh, gosh, you missed out on that. No, I didn't. All I care about is my returns. I don't care what the market's doing per se. Yeah. I care what my portfolio is doing. And if we keep that in mind, you'll be fine.
Well, happy birthday, Tim.
Thank you.
Can't hit every pitch, I like to say it. I refer to it in baseball. You can't hit them all, right? So
no, you can't.
You just wait for the next setup and get ready for it, right? So let's take a look, of course, underneath the hood. Of course, we always talk about two main things, right? Is it momentum? Is it volatility? Seems like this might be a momentum rally, or is it something else? Let us know, Tim. What is the data telling us on Market Structure Edge?
Let's have a look. Oh, and by the way, here, this is Aspen. This is where we were.
Hold up. The good stuff.
This is my
I don't get to go out to those mountains. Yeah. Those are little special mountains out there.
And it all came on a day. Like they got 2 feet of snow. It was just very, very spectacular, and a great place to get fat if you want to do that, because there's great restaurants.
Great steaks and cold weather, baby.
Exactly. Yeah. I went to 316 Steakhouse too, by the way.
Hell yeah.
It's one of the places.
You enjoyed that, Tim.
I did, and I'm paying the price. Now I'm eating salads. But anyway, so here's I want to show you two things. What is it? So Mitch, to answer that question, is it a momentum market? Well, if you look at the portfolio, no. And you say, well, why not? I mean, what happened?
Why not?
Right? And I'll tell you what I think. Can I prove this entirely? I can tell you that the market was very likely to rise because of this. If we zoom in and look at the broad picture, and it tells me how many people are doing some of the same things that I do. I will trade long and short with ETFs. I don't love ETFs. They are a substitute that expands access to the same underlying securities, and at some point that will break, because it's not the correct way for markets to function. Nonetheless, I will do it. Well, then you can overload the derivatives market, and it doesn't show up in the asset market. But here's what I want to show you. We say when you get to the green line, that is a bottom. And statistically, it has been true 100% of the time in the data set. At some point, it will be wrong, the uncertainty principle. And look what supply was doing. So on October 30, the SPY was at 416, let's call it, and it hit the green line, and supply declined day over day. Well, that's a very good indicator of a bottom. Now, human nature, because the market got clocked, we just got corrected. Would you look at that? And, it's David Copperfield. We're looking at the hand waving, not what's actually occurring. If you looked at that, you would say, wow, the market's probably going to go up. And look what has happened to the supply side. There has been a collapse in supply, short volume. Yeah. Almost equal to the move in the market. So is it a momentum market, Mitch? No. And that's why it can fall apart at any moment. I'm not saying it's gonna, I'm not predicting that. But this was a collapse of supply, and I would relate it to that little green square there. there were index futures, trillions of dollars of them, they expire every month end. And I think what happened is that banks shorted the market before that because they were going to have to cover it to bring index funds whole. Because if you lose 10% of your value, you're out of whack with your measure. And so they rely on the Goldman Sachses of the world to get there. Well, then machines will immediately run prices up. Machines don't understand things. And I want to add a little piece, if I can, to this, because I think it's illustrative. If I go back over here to where we are, I want to show you something. So there was a lot of discussion about how, well, it was the Fed's quarterly refunding and a reduction in the supply of the 10-year that caused the market to rally mightily. Well, let's look at the data. Here's their release. I looked at the data and went, it's not a reduction. Look at what they're doing with the 2-year, 45 to 60 billion, 3-year, 42 to 52, 5-year, 46 to 61, 7-year, 36 to 41. Here's the 10, 38 to 37. It's coming down 1 billion. But if you add up the totals, it is a colossal increase.
That moved the market too, Tim.
Well,
that was like, we had 2830 numbers. I don't even know what their numbers are. Or another thing was wage growth or something. Tim, before we let you go, we got to talk about turns in the market, right?
There's a linchpin yet to this, because this is very important. The same thing happens to public companies. This is machines that don't understand data, reading things and reacting to them. It happens. Look at Roku. I mean, should Roku be up 48%? It lost $1 billion over the last 4 quarters. Okay, so the machines don't understand fundamentals, but 90% of the volume in the treasury market and in the equity market come from machines, models, and derivatives. They don't think. And these things can happen. That's why it's very important to understand the mechanics. Okay, Joel, sorry. I wanted to
What's
make
the data say now?
I want to expand on that question. What happens when they do start thinking? Because AI is coming to the markets. And people would say AI is there already, but it's not. It's just computer programs being run by, whatever been programmed into them.
There is an
what happens when
AI order type.
AI actually comes in and starts
NASDAQ
trading and now making and changing their own code to adjust for market conditions? Does this put us all out of business, or are we just putting the cart before the horse?
It's a great theoretical question, right? Because we don't know. And
I want to know, because I got to know when I got to send my resume out to McDonald's or not. So.
You get paid well now.
Right?
I get $18 an hour in here in town at McDonald's.
There is an AI order type from the NASDAQ now, the Mellow. I forget, it's D or L Mellow. You can look it up, but that's AI powered. It's using generative data to change where the order floats, right? Midpoint, what is it? Something limit only. I forget the acronym. I can find it. Anyway, just remember, AI is generative, not creative. AI will consume and reformat, transform the things that exist. AI does not invent things. Humans invent things. Humans are creative. Humans can foster something from nothing. Machines can only reformulate it. That's why it's called generative pre-trained transformer. That's what GPT is. It can only be pre-trained. So I wouldn't be brushing my resume up, Dennis, if I were you. I think you'd be just fine.
I don't really want to go flip burgers for the next 15 years, but if I have to, I guess I will.
No, what will happen is they'll become the same. What happens when you apply broad techniques to data sets is the data sets all become the same. So we will, everything will sound the same, look the same, feel the same. There are things it's going to do really well. Being able to take a meeting and have AI transcribe it and send notes to everybody. That's a great use of AI. To take a press release and turn it into a presentation with PowerPoint slides. Right, that is a great use of AI. But there are limits to it because it's not creative.
Agree, and that's definitely something to look at. Joel, you wanted
just a turn. Yeah, we've had the rally. What do you look for? We're still up here, 6-day winning streak. I look for some consolidation, a double top. We don't have any of that stuff right now to on the plate. What are you looking for in market structure for a potential turn or for a little buy the dip opportunity?
Well, and if you looked at the data, Joel, so we always say, always look at broad market sentiment, understand where it is. When it's below the green line, that tends to be a bottom, and stocks rise. Below the green line, stocks rise. Below the green line, stocks rise. But this was happening even as it was getting there. And there's a big drop in the supply side, but let's back this out. Let's just back out to a year-to-date view and see where we are, demand and supply. So this was the big, here's the surge. In June into July options expirations, that was a great run because look at the supply side, no supply. We've had a steep reversal here, but I don't think, everybody says now we're going to have a rally into the end of the year. I don't know what's going to happen, but I look at the supply demand data and say this is heavily dependent on derivatives. The problem with derivatives is that one data point causes them to get marked to zero. They're 20% of market cap. So while I think, and I'm with you, Dennis, I'm bullish short term simply because broad market sentiment is 3.5 and rising and supply has fallen. But how quickly would this change? I think
can change fast.
Yes, it can. And I think even before November options expirations, we could have trouble. I think there is something occurring in the derivatives market that concerns me. I mean, I saw the Chinese overnight market spike to 50%. Did you see that? The Chinese overnight lending market spiked to 50% on October 31st. There wasn't any money in the system. Happened to us in 2019. You get some weird things like that occurring. You get the Koreans, as you said, we're pausing shorting. That's not what well-functioning markets do. These things concern me. I would be very tactical. The only thing I will trade right now is if there's no momentum, I just believe the data. There's not momentum, so I'm going to trade derivatives. I will trade ETFs, long and short, and I will trade big tech. Why? Because it's the linchpin of the market. If demand is rising, see, it's rising, it bottomed. You could go buy AMD when it hit 1. That's a very reliable trade, and you make 12% on it already. But other than that, I'm being very careful because I do not trust this market.
All right. Tim Quast, CEO of Market Structure Edge, joining us here on Pre-Market Prep. Tim, you're always fun to have on. We'll dial you up again soon.
Good to see you, Joel. Enjoy your visit to our town. I'm sorry we're going to be gone. We take off on the 8th to go to the Texas A&M Aggies game. My wife's an A&M Aggie, and we've got a big reunion with some friends down there. So I'll miss you. I'll catch you the next time.
All right.
All right, guys. Definitely give Tim Quast a follow. And, of course, check out Market Structure Edge. It's always great to have you, Tim.
Thank you, guys. Have a good week.
Thanks, Tim.